Hey everybody, welcome back to the bonus section. Now, some of this is going to seem repetitive to you because we've kind of gone over these things a couple of times, but I want to go into a little bit more detail about these tax deductions that you have and what's unique about them. So let's start off with the 27.5 year depreciation schedule. Now, of course, as I've said before, it does not include the land that it's on because land is not ever going to change. It's not something that's depreciated. So I'm going to give you an example here, though, so you can get a little better idea of how it benefits you. So let's say we bought a $200,000 house and the land cost we estimate to be $40,000. So what can be depreciated is what's left, $160,000. Well, we divide that by 27.5 years, divide that by 12, and that's the amount of monthly deduction you can do. So let's say you had a fantastic buy, you're making net $300 a month. What happens is if you take that depreciation schedule I just gave you, that's a $484 per month deduction off your taxes, which basically means you're losing to the IRS $184. That's how they look at it, not how you look at it. That's the advantage. This is the biggest thing that's great about real estate investment. And then let's say that you had other improvements and things you did that was another $10,000, let's say, over that 10-year period. Then at that point, you're talking about losing $244 a month according to the IRS. And again, all this carries forward. So just like on that first example, without any improvements, we're talking about over $22,000 you don't have to pay in taxes. So that's really an advantage of doing this. Now, you're going to have to justify what the land value is. So you can't just say, oh, I'm going to make it 90% improvements, 10% land because I'm going to have a better depreciation schedule. A little crazy in that particular respect. So essentially, if it's a builder, you can find out from them what the lot cost, say, how much did you pay for this? Or the tax records. And whatever's better, that's the one that I would use. And you can always point out to the IRS, I got this from the county records, from the city, from the county. So therefore, that is what they valued at, and that is legitimate. So that is one of the ways that you can do this. And like I say, in that example I gave you, it normally offsets any profits. Now, if you own it free and clear, it's not going to do it, but it's going to reduce your taxes still dramatically if your property is completely paid off. But of course, if you're just starting out with this, then you've got financing. So you've got that, what we talked about in terms of using a mortgage, putting, say, 20% down. So it's going to benefit you tremendously. Now, repairs and upgrade deductions, a lot of times, they're going to be put on that 27.5 years. You're going to need to consult, like with any of this, with your tax professional about how you can deduct it. And everything that you do to that house in repairs, everything that you do to that house when it comes to improvements, basically you really need to keep records. Now, I'm not going to say that the IRS is going to audit you, but we're the most likely target of the IRS because big corporations, you got to have about 10 or 12 lawyers to go after them. With us, we're easy. So you want to make sure that all your ducks are in a row, as we used to say, and keep those things going. So insurance deductibles are also an expense. So there's different things that you can do, again, to minimize your taxes. Now, one of the things that I like is travel expense deductions. And one of the things I do like about them is typically they can be deducted not on the 27.5 years, but on each year as a deductible expense. So, if you're buying out of state, you can go visit your properties. Now, it's a situation where, if you're in the mountains of Colorado and the beaches in Florida or wherever it happens to be, it still needs to be a primary reason that you visited. Doesn't mean you can't have a good time. I think you should have a good time. But, airfare, car expense, taxis, food, all of those things, where you stay, those are all considered deductible expenses and normally within the year that you go. Now, obviously, if you go to that house 5 or 6 times a year because it's a great place to go, that might be a little bit too much. So again, your tax professional is going to tell you what's can be tolerated without putting up, a big red flag to the IRS about you. But one of the great things is you can deduct this way, and you can deduct it more annually than on the 27.5-year depreciation schedule. Now, this is just a basic disclaimer. We've talked about this a little bit before, but I just can't emphasize this enough. If you're dealing with a realtor, they cannot give you financial or legal advice unless they're a CPA or a licensed attorney. In other words, we can do what I just did, consult a tax professional, consult your attorney. We can make you aware of these things. We can kind of talk about it in general, which is what we did. But when it gets down to the details, like on travel and depreciable expenses that you have, these are things that you need to check with the professional about, because they're the ones that are going to make sure that you stay safe and free and clear from the IRS. And that's extremely important to you. And like I say, one of the things we always have to say on everything that we basically said in this class is believed to be true, but always check for accuracy on anything. In other words, get a second opinion, no matter what. It's not a bad idea to basically go, well, let me just get a little bit more out of this and see and make sure that everything is right. So understand the limitations. There's a lot of things that we can do, but there are limitations to what we can do. That's why we tell you to go consult a professional. They're going to take care of you. So that's my disclaimer, and you should get this from anyone. All right, so we got a few more sections to go. This next section is going to be the secret to tax-free real estate profits. We can go a little bit more about how you can just keep this thing going.